What's up, guys? This is Irene Aldrich, and I haven't seen you in so long. Well, guess what? Today I have a new study for you that basically compares factor analysis using linear regression with the same using big data analysis. And of course, don't forget about our big data science book that just came out. You can get it on Amazon. And there's a book webpage, which is bigdatafinance.book.com. Okay, so I'm going to show you though the study. The study is available on ablemarkets.com website. It's a brand new study. Let me share the screen with you to actually show you with this. Okay, so here's the Able Markets website. This is the company that I run. And if you scroll down a little bit, or if you press research on the bar on up top here, this is our latest notes. Here is actually our beta predictability, and this is the study. So let's look at it. Okay, so what we're going to do is we're going to use different factors, try to predict 5, 10, 20, and 60-day beta in equities. Okay, so beta, as you know, is basically a regression coefficient of equity returns on market returns. And for the market returns, we typically use the S&P 500, although some people use equally weighted returns, market returns. In our book, by the way, we show that S&P 500 is a better proxy for market returns from the big data perspective than is the value-weighted index that some people like to use, or Russell 3000. S&P 500 really is it. Okay, but let's look here what we're going to see here. So first we go into traditional analysis. And in a traditional analysis, we just have a linear regression with a bunch of coefficients. And these coefficients, in this case, we have market return, and we're looking at forward-looking beta. Okay, so we compute betas and we compute preceding market return. And then we have a rolling window that keeps moving along. So, and today's, we're stacking these regressions, they're cross-sectional regressions. So we have today's market return predicting that the beta computed over the following 20 days. All right. So what we see here is market return is meh, not so predictive. It's sometimes, especially if you look at the p-value, most of the time it's 0. It's very, very blah. Okay, this is again linear regression setup. If we look at institutional participation, it's something that our company measures. The p-value is a lot more significant, and p-value, of course, is the probability that this factor is actually very significant. Now, it's not less significant in periods of high volatility, but overall, it's doing pretty cool, and it's delivering pretty solid predictions. So this is we report our company reports institutional flows for buy flows and for sell separately. So this is buy flows. We can do the same for sell flows. It's also extremely significant if you look at p-values or t-stat. Okay, next we will consider aggressive Hft participation. And here there's the difference between buy minus sell. And you can see this one is actually very significant in times of high volatility. So institutional participation was not so significant in times of high volatility, but aggressive Hft is. Okay, finally, we're looking at 20-day beta preceding beta. Okay, so we instead of we're still using the same dependent variable. It's our independent variable is now the beta that was computed on the previous 20 days. Again, it's all in the rolling window format. And yeah, it's kind of predictive, right? So it's betas are persistent in many cases, but in many cases it's not that predictive, especially in, again, periods high volatility. It's maybe it's sometimes it's working and sometimes it does not. Okay, so and then finally, what do we have here? We have the Intercept, right? So this is we run these regressions with Intercept, and the Intercept, yeah, it's kind of important, but it's not the most important part for us. So when we do the big data analysis, okay, so we're doing it differently. So again, we have this mixed bag. We have the same vector. Now we include everything, and we're trying to figure out which which factors are most important for telling the story that we're trying to tell about the data. Okay, so we're running the SVD analysis, and then we take the first eigenvector or a singular vector, and we're opening it up and looking what's inside. So here's what IAA by. It's very, very vivid, and it explains a large proportion of variation in the entire data set. Okay, so this is institutional activity on by flows. These are institutional activity cell flows. They're also very important. However, they become less important during periods of high volatility at the end here. Okay. Next, we're going to consider the difference in aggressive HFT participation. It becomes more important when the volatility is high. The following one is the preceding market return. So this is very interesting. So this preceding market return is, you can see that it's very negative. It hardly ever rises above zero. And so what it's telling us that this market return is only important when the market return is negative. So when it's negative, it actually explains a lot of volatility. When it's positive, it's not. And if you think about it, if you go back to various studies that analyzed flash crashes or market crashes altogether, what they say it is that when the market return is negative, then all the betas converge. So all the stocks start falling together at the same time, right? When the markets are rising, some stocks are going up and some stocks are going down. So this clearly illustrates this point. We have market return. We're trying to again figure out how it's important in the context of different betas and all the other variables we have in this mixed bag of data. And what this is saying to us is that market return matters when it's negative. When it's positive, it doesn't really matter so much for the other variables that we have in our bag. Okay, and here's the preceding beta and it has very little, it explains very little variance in the data set. Okay, so it's not that important at all compared to the other variables we looked at. All right, so and then here we can construct a portfolio. It's just a very simple use case of how to monetize this information. So if you have the institutional investor activity index and aggressive HFT index, you can make a really nice portfolio. This is a position, so this is not the return. Don't worry, there's no dip in the return. So this is the cumulative position that you create the market risk neutral position portfolio rather, and using the information we just talked about, and then this section explains how. So most of the time you would be, and this is based on Russell 3000. Okay, so most of the time you would be mostly long, but then when the crisis came here, you would actually close it all off. Okay. These are the returns that you would realize from this market neutral portfolio using the analysis that we describe in this section. So check out the analysis and let me know if you have any questions. Now it's very simple. It's irene@ablemarkets.com. You can shoot me an email. Okay, thanks so much, and hope you subscribe. Subscribe to my channel, please. Thanks so much. Take care. Bye.